One of the biggest misconceptions investors have is that every increase in their investment account creates a tax bill. In reality, that's not usually how it works. I'm Bobby Finn with Beacon Light Wealth Management, and today we'll explain what capital gains are, how they're taxed, how capital losses may work in your favor, and a few things you should think about before selling an investment. Let's get started. What are capital gains? A capital gain is simply the profit you make when you sell an investment for more than you paid. For example, let's say you invest $20,000 into an ETF. A few years later, if it's worth $30,000, you decide to sell it. Your profit or capital gain is $10,000. Now here's one of the biggest misconceptions about investing. Just because your investments go up in value doesn't automatically mean you owe more in taxes. In many cases, taxes don't come into play until you decide to sell. If your account goes from $20,000 to $30,000, but you don't sell anything, you haven't created that taxable event. The important thing to remember is this: it's generally not the growth of your investment that creates taxes, it's the decision to sell it and when to sell it. So how are capital gains taxed? Not all capital gains are taxed the same. One of the biggest factors is how long you've owned the investment. If you've owned it for 1 year or less, it's considered a short-term capital gain and is typically taxed at your ordinary income tax rate. If you've owned it for more than a year, it's considered a long-term capital gain, which often receives a more favorable tax treatment. Taxes shouldn't be the only reason you make an investment decision, but they should definitely be a part of the conversation. But what about capital losses? Now, nobody likes seeing investments lose value. However, capital losses may provide tax benefits depending on your individual tax situation. Capital losses generally offset capital gains first. For example, if you sold one investment with a $20,000 gain and another with a $12,000 loss, you generally recognize an $8,000 net gain. If your capital losses exceed your capital gains, you may be able to deduct up to $3,000 per year against your ordinary income, subject to IRS rules. Any remaining unused losses generally carry forward to future tax years. You may also hear the term tax loss harvesting. Tax loss harvesting is a strategy that may help improve after-tax outcomes for some investors by realizing investment losses that offset gains, while the primary focus on the long-term investment strategy stays true. The goal isn't creating losses, it's making your investment strategy more tax efficient when appropriate. It is important to take a step back and ask yourself a few important questions before selling investments. First, why are you selling? Has your financial plan changed? Or are you reacting to short-term or news headlines? Second, what will the tax impact be? Selling an investment with a large gain could increase your taxable income for the year, so it's helpful to understand the potential tax consequences before you make that decision. And finally, what's the plan after you sell? If the investment was part of your long-term strategy, you don't want that cash just sitting there indefinitely. Make sure you have a plan for where those dollars are going next. Sometimes selling makes perfect sense. Other times, waiting or even spreading those sales out over many years is worth considering. Depending on your overall financial situation and goals, make the right choice for you. Capital gains and losses are more than just tax concepts. They're an important part of your overall financial plan. Understanding when gains may become taxable, how losses may help offset gains, and thinking through the decision before you sell can help you make more informed financial decisions. Tax laws also can change very frequently, and every investor situation is different. It's important to consider these concepts with your own financial and tax circumstances in mind. If you found this video helpful, be sure to hit that like button on the video and subscribe for more content with investing, retirement planning, tax strategies. If you'd like to learn how those concepts fit into your overall financial plan, we'd be happy to have a conversation. Thanks for watching, and we'll see you in the next video.